All right, now this is the first pattern, which is called a gap up short. A gap up short winning percentage, as you can see on the top right, is between 6 to 80%. That depends on different criteria and the variations. The median winning percentage is about 70%. The frequency, it happens anywhere between 20 to 40 times a year. Sometimes it happens up 100 times a year on a year of 2021. But on average, it happens anywhere between 25 to 40. And hotter years without QT, I think it's around 30 to 40. So that's the frequency and the winning percentage. Now, this is the criteria. First of all, it has to trade at least 4 million volume in the pre-market. If it doesn't trade 4 million volume, the volume is too light. First of all, you cannot estimate the volume. Second, the volume is way too light. You kind of have to wait until the volume starts to form after the open. So you will see if it actually trades any type of volume or not. If it doesn't trade any type of volumes after open, if it's still under 4 million, most of the time it's not tradable. So keep that in mind. That's number one criteria. Number two is the minimum spiking percentage has to be 70%. Ideally 70% to 150%, no more than 200%. So if the ticker exceeds over 200% on the gap up short, it will reduce its winning percentage. And it's still considered to be a gap up short, but winning percentage will significantly get reduced. And after open, the stock has either to spike above the open price, which will be 20% above of the open price. And the faster the spike is, the better. And if it takes time and goes into 1 p.m. and spikes 20% from the open, that does not count as a gap up short. That spike has to happen within the first, I would say, 1 hour to be able to be effective. Now, if it's dragging down 3 to 4 hours and turn the chart off, not tradable. Same thing. Fourth point is float has to be under 20 million. Pretty simple. And if the float is under 1 million, it's a nano float. And if you don't have a great risk management, you will get squeezed or get shaken out. So if you really want to trade that microflow, track your own statistics, practice into it. Also, nanoflow and microflow do not support big size. Also keep that in mind. Then the initial market cap has to be 0 to 200 million. Ideal range has to be 20 to 100 million for the initial cap. If the initial market cap is under 10 million or under 5 million, then the stock will get really tricky because the stock becomes way too cheap for people to buy, and it's likely to push its own market cap up to a really high range. As I said earlier, that 200 million initial market cap needs $200 million to be injected into the market cap for the stock to go up 100%, correct? And if you have 5 million, then it only takes $5 million for the stock to go up 100%. So that's a little bit too easy for the market makers to pump that thing up. So they can actually, use the 20% pushing percentage to trick people to get in. Then since the market cap is only 4 million, it can push it up to 50%, 100%. So stay away from the lower market cap range, especially on the initial market cap. Ideal range is 20 to 100 million. All right, so let's talk about the winning percentage factors. There were some points I want to really point it out for the tickers that you want to be avoiding. And some of the tickers will drop your winning percentage or increase your winning percentage. So L means losing percentage, W means winning percentage. So L, that means this 20. If it's the 3 criteria in the box, that means your gap up short will lose 20% winning percentage. So your 70% average will go down to 50%. So number 1, if it's a biotech or energy stock sector and instantly drop by 20 to 50, I will prefer 50 than 20. 20 is a little bit too conservative. Then if it trades more than 40 million shares in the pre-market, that means the estimated volume is 400 million. That means the stock gets way too crowded. And it doesn't really matter if it pushes 20%. That will drop the winning percentage by 20%, probably more. So, and you do want to avoid stocks trades over 40 million shares in the pre-market. It doesn't really matter, it's a bound short or gap up short. Number 3, gap up short pre-market percentage over 20%. As I said, if it exceeds over 20%, it does still qualify as a gap up short, but the winning percentage is going to drop by 20% as well. So those are the 3 criteria you want to be aware of. Once you scan for a stock, you look at the market cap and float, you look at the historical chart, stay away from consistently downtrending chart, then you also want to filter out all those three factors. Now let's talk about the winning percentage. After it qualifies for a gap up short, it pulls 15% from the open instantly, then respike 20% above the open price. That will likely to increase the gap up short winning percentage. Second, if it trades low volume in the pre-market and higher volume after open, it's likely to increase the gap up short winning percentage. It's because that if high volume comes in after market open and low volume in the pre-market, as I said, that a gap up short is when you are building a foundation for a house. If there's not enough volume in the foundation, that means the house is likely to fall apart because there's no foundation. If it's heavy at the top, light at the bottom, then it's likely to fall apart. But if it's heavy at the bottom, heavy at the top, then the house is unlikely to fall apart. So pretty much the same thing. If it trades 4 million volume in the pre-market and instantly trades 40 million volume in the first hour of open, then you're looking at the situation that the foundation is not strong, the stock is likely to fall apart. So in this criteria, it's likely to increase the winning percentage by 15%. Then number three, volume plus price suddenly increase right before the bell opened and increase by 10%. The same concept compared to as number two is because same thing. If all the volume is concentrated after open, then the stock start losing liquidity after the first hour, then it will increase your winning percentage. And the second one is if the lower volume is at the bottom, then the stock is likely to fall apart if it trades heavy volume after open first hour. Very similar, but slightly different.